Hi, this is Mike Swanson of Wall Street Window. Got a really special guest. I got Jordan Lloyd Byrne, who owns the website thedailygold.com. How you doing, Jordan?
Hey, Mike. I'm great. Thanks for having me on.
Yeah, it's been a couple months since we last talked, and a lot sort of has happened in the stock market. The broad market fell in April and May and has bounced back. I'm not sure if you know, but in April, I started taking some positions in gold stocks because I thought they'd gotten to a really, really cheap level fundamentally. But then actually they bounced up after I bought, and then they came back down to where I got in at, and I got stopped out, and they fell, some more, and they bounced back up to where I got out of, and then since they've fallen back down, and I'm still interested in getting back into them at some point, but I guess I got a black eye from doing that, and makes me a little hesitant. So, wondering what's your opinion on them right now?
Well, I mean, the gold stocks were. I actually was looking for a major bottom in May. There at the GDX bottom to 39, and I was pretty confident we were going to get a good rebound from there. The rebound's fizzled to this point. Now I see two scenarios going forward. One, either we kind of bottom here in a gradual base building, grind it out type of process, or at some point in the next month or two, or maybe in October, we get a final move down, which kind of a capitulation type move where we break the May low, but it's a quick, lose 10 or 15% in 2 or 3 days type of move, and then from that point the sector starts to rally. So I mean, if we stand back and look at this from a very broad view, we're obviously very close to a major bottom, and I think the market, fundamentally speaking, is waiting for a catalyst. I mean, we need some catalyst that will bring about the next cyclical bull market in this sector, and obviously, there's a lot of potential catalysts out there with. Europe, potential major action there being one, and then you look here in the U.S., our economy is slowing towards recession. So, and on top of that, if there's a negative situation in Europe, that could possibly prompt more action from the Fed. And if you look over in the East, China has started cutting interest rates, and their real interest rates are actually rising right now. So I would expect them to continue to cut interest rates. And so, I mean, if you're looking at what's going on in the world, there's a lot of potential catalysts there, which are going to drive this market higher. But of course, the question is the timing. So I'm not sure these catalysts are going to emerge right away. It may be towards the end of this year or early next year. But at the same time, remember, markets always move ahead of fundamentals. So, I do think after October, I think for sure this market is going to be in a better position. It's going to start to move quite a bit higher.
Yeah, I'm seeing the same sort of thing. Maybe getting to that conclusion in a different way. I think the European debt crisis is likely to blow open again in the fall, and we'll finally see some real intervention take place. Maybe they'll make Euro bonds or some sort of really big money printing, which they've been hesitant to do. And that will force the Fed here to do the same thing, because they're not going to want the euro to just take off and go crazy. So we're going to want to try to balance things out and join in on that. And plus the economy here is slowing down, like you said. But the thing is, at the moment, I think the Fed is very anxious to do anything. They don't want to become part of the headlines. Historically, the Federal Reserve doesn't really want to do much right before a presidential election, because they don't want to become part of the news. And Bernanke is even a more political Fed chairman than most of them have been historically. People forget, but before he was Fed chairman, he was on George Bush's Council of Economic Advisors for several years, and proved to Bush that he would be a money printer. And Bush needed that to finance the big deficits, and he's continued to do that for Obama. So he doesn't want to do anything to cause attention to Obama himself, in my view. But regardless, that's my speculation. And the thing is, either way, it seems like the charts are lining up too for some sort of turning point in October. And I don't know if that means we go lower, like you said, or things just base out. But definitely seems like a couple months of action. Now, before we started recording the interview, you were telling me about some of these valuation metrics that you're seeing in gold stocks. I was hoping you could mention that a little bit for our listeners, because it's real interesting stuff you're talking about.
Yes, I definitely could mention that. And well, firstly, let me just say I completely agree with what you said about Europe. I think you actually said it better than I did. Europe is not going to act until they reach a panic or crisis type point. Now, that being said, moving on towards valuations, there was a chart in a recent investor letter from Tocqueville, the Tocqueville Gold Funds. John Hathaway is the head of Tocqueville, and there was a chart that had the price to cash flow ratio of the senior gold producers, and their the current price to cash flow. I forget where it is exactly on the chart, but I can tell you it is right at the same level as the low in 2008 and the low in 2000 at the beginning of the bull market. So valuations could not come down anymore. So that means two things. Either gold has to move materially lower. So earnings will get worse. That's one way valuations can go higher. The other way, which I think is more likely, is eventually, sometime in the next 3 or 6 months, we are going to see gold moving back higher, and that's going to obviously have a positive impact on earnings and cash flow in this sector. Now, and just taking a step back and looking at the bigger picture, Mike, it's important to understand when you get into the last phase of a bull market, and I don't know if we're quite there yet, we're still kind of in the wall of worry phase. But we're 11, 12 years into this bull market. Once you kind of get to the 13, 14 years into it, the reason why performance is so great in the last third of a bull market is because you have a combination of rising earnings and rising valuation. So in other words, let's say your average senior gold producer is trading at 10 or 11 times earnings. Well, you go back to 2005, 2006, 2007, these stocks were trading at, believe it or not, like 30 or 40 times earnings. So just imagine how much some of these senior producers can rise, the share price can rise, I should say. If you have a 10 or 11 or 12 PE right now, if that PE goes up to 20 or 22, and at the same time their earnings rise. I mean, so that these stocks can rise substantially because you have that 1-2 punch of a rising valuation, and they're making more money at the same time. So that's something that I'm looking. Is that going to affect these stock prices, in the next couple months or the next 6 months? No, it's not. But I think this is going to be a real powerful driving force, over the next 2 to 3 years or so.
Yeah, it really seems like gold is something like a sleeping giant, where people are losing attention for it, or they've gotten shooken out, or whatever. You'd hardly ever see it talked about anymore on CNBC at all. So do you have any ways to gauge sentiment scientifically, or in other services you subscribe to or anything? I mean, I'm just saying something from what I'm seeing on television. Do you have any more data on something like that?
Well, I subscribe to sentimenttrader.com. They provide many different sentiment indicators. They have public opinion polls. I look at the Commitment of Traders report. And here's a couple things I'll mention about the COTs. Right now in silver, the long positions of the speculators are at an 11-year low. I mean, can you believe that? They're at the lowest point basically since the very beginning of the bull market in silver. So that shows that there is really, the speculative interest has been completely wiped out as far as silver. If you look at gold, it's basically the speculative long positions are at the lowest level since late 2008. So looking at those, and in the futures market, There's really no speculators left. And that's why, it's interesting, Mike, because if you look at the price action of gold and silver, they both actually look like they're going to break lower. And that's still possible. In the last couple of weeks, I've had that view. They've looked like they need to break lower to really put in a bottom. And one reason why they have yet to do so could be because if you look at the COT data, perhaps all of the weak hands have been cleared out, and even though these markets are still very thin, what that could imply is that they're going to kind of, as I said at the very beginning, they could grind out a bottom that would, take another 1 or 2 months or so.
Well, gold is notorious of sometimes breaking, a big support level like you can see on the chart, and then really just falling for a day or two and turning right around. That's the final bottom. So I could see that easily happening.
No, absolutely. That's a great point.
Well, as we wrap up, could you tell people what you provide and where they can go to for more information from you?
Well, they can go to my website. It's thedailygold.com, and we focus obviously intensely on gold and silver. Essentially, we focus about half of our work on market timing and the other half on stock selection, focusing and picking the right companies that are going to outperform the sector. And also, twice a month, we do updates on essentially the rest of the markets, what's going on with bonds, emerging markets, currencies, and things of that sort, because those things impact gold, and it's very important to know what's going on outside of the precious metal sector.
Well, thanks for taking the time to talk about it. We'll definitely do a follow-up interview in the future.
Hey, Mike, thanks so much for having me on.